Time-weighted return. Time-weighted return (TWR) is a method of calculating investment return. To apply the time-weighted return method, combine the returns over subperiods by compounding them together, resulting in the overall period return. The rate of return over each different subperiod is weighted according to the duration of the subperiod. The time-weighted method differs from other methods of calculating investment return only in the particular way it compensates for external flows. See below. External flows. The time-weighted return is a measure of the historical performance of an investment portfolio which compensates for external flows. External flows are net movements of value that result from transfers of cash, securities, or other instruments into or out of the portfolio, with no simultaneous equal and opposite movement of value in the opposite direction, as in the case of a purchase or sale, and that are not income from the investments in the portfolio, such as interest, coupons, or dividends. To compensate for external flows, the overall time interval under analysis is divided into contiguous subperiods at each point in time within the overall time period whenever there is an external flow. In general, these subperiods will be of unequal lengths. The returns over the subperiods between external flows are linked geometrically compounded together, that is, by multiplying together the growth factors in all the subperiods. The growth factor in each subperiod is equal to 1 plus the return over the subperiod. The problem of external flows. To illustrate the problem of external flows, consider the following example. Example 1. Suppose an investor transfers $500 into a portfolio at the beginning of year 1 and another $1,000 at the beginning of year 2, and the portfolio has a total value of $1,500 at the end of the year 2. The net gain over the 2-year period is 0, so intuitively, we might expect that the return over the whole 2-year period to be 0%, which is incidentally the result of applying one of the money-weighted methods. If the cash flow of $1,000 at the beginning of year 2 is ignored, then the simple method of calculating the return without compensating for the flow will be 200% $1,000 divided by $500. Intuitively, 200% is incorrect. If we add further information, however, a different picture emerges. If the initial investment gained 100% in value over the first year, but the portfolio then declined by 25% during the second year, we would expect the overall return over the 2-year period to be the result of compounding a 100% gain $500 with a 25% loss also $500. The time-weighted return is found by multiplying together the growth factors for each year, that is, the growth factors before and after the second transfer into the portfolio, then subtracting 1 and expressing the result as a percentage. 1 plus 1.0 minus 0.25 minus 1 equals 2.0 times 0.75 minus 1 equals 1.5 minus 1 equals 0.5 equals 50%. We can see from the time-weighted return that the absence of any net gain over the 2-year period was due to bad timing of the cash inflow at the beginning of the second year. The time-weighted return appears in this example to overstate the return to the investor, because he sees no net gain. However, by reflecting the performance each year compounded together on an equalized basis, the time-weighted return recognizes the performance of the investment activity independently of the poor timing of the cash flow at the beginning of year 2. If all the money had been invested at the beginning of year 1, the return by any measure would most likely have been 50%. $1,500 would have grown by 100% to $3,000 at the end of year 1, and then declined by 25% to $2,250 at the end of year 2, resulting in an overall gain of $750, that is 50% of $1,500. The difference is a matter of perspective. Adjustment for flows. The return of a portfolio in the absence of flows is $R equals \frac M2 M1 M1 $, where M2 is the portfolio's final value, M1 is the portfolio's initial value, and R is the portfolio's return over the period. The growth factor is $1 plus R equals \frac M2 M1 $. External flows during the period being analyzed complicate the performance calculation. If external flows are not taken into account, the performance measurement is distorted. A flow into the portfolio would cause this method to overstate the true performance, while flows out of the portfolio would cause it to understate the true performance. To compensate for an external flow, C1 into the portfolio at the beginning of the period, adjust the portfolio's initial value M1 by adding C. The return is $R equals \frac M2 M1 plus C1 M1 plus C1 $. and the corresponding growth factor is $1 plus R equals \frac M2 M1 plus C $1. To compensate for an external flow C2 into the portfolio just before the valuation M2 at the end of the period, adjust the portfolio's final value M2 by subtracting C. The return is $R equals \frac M2 C2 M1 M1 $, and the corresponding growth factor is $1 plus R equals \frac M2 C2 M1 $. Time-weighted return compensating for external flows. Suppose that the portfolio is valued immediately after each external flow. The value of the portfolio at the end of each subperiod is adjusted for the external flow which takes place immediately before. External flows into the portfolio are considered positive, and flows out of the portfolio are negative. $1 plus R equals \frac M1 C1 M0 times \frac M2 C2 M1 times \frac M3 C3 M2 times C dots times \frac M-1 C N-1 M M-2 times \frac M N C N M M-1 $, where R is the time-weighted return of the portfolio, M0 is the initial portfolio value, NT is the portfolio value at the end of subperiod T immediately after external flow CT. MN is the final portfolio value. CT is the net external flow into the portfolio which occurs just before the end of subperiod T. And N is the number of subperiods. If there is an external flow occurring at the end of the overall period, then the number of subperiods N matches the number of flows. However, if there is no flow at the end of the overall period, then Cn is 0, and the number of subperiods N is 1 greater than the number of flows. If the portfolio is valued immediately before each flow instead of immediately after, then each flow should be used to adjust the starting value within each subperiod instead of the ending value, resulting in a different formula. $1 plus R equals \frac M1 M0 plus C0 times \frac M2 M1 plus C1 times \frac M3 M2 plus C2 times \frac M M-1 M M-2 plus C M-2 times \frac M N M N-1 plus C M-1 $, where R is the time-weighted return of the portfolio, M0 is the initial portfolio value, MT is the portfolio value at the end of subperiod T, immediately before external flow CT. MN is the final portfolio value. CT is the net external flow into the portfolio which occurs at the beginning of subperiod T plus 1. And N is the number of subperiods. Why it is called time-weighted. The term time-weighted is best illustrated with continuous logarithmic rates of return. The overall rate of return is the time-weighted average of the continuous rate of return in each subperiod. In the absence of flows, end value equals start value times E R logged, where R log is the continuous rate of return and T is the length of time. Example 2. Over a period of a decade, a portfolio grows by a continuous rate of return of 5% p per annum over 3 of those years, and 10% p over the other 7 years. End value equals start value times E 0.5 times 3 times E 0.10 times 7. $, equals \text start value times E at 0.5 times \frac 310 plus 0.10 times \frac 710. I at times $10. The continuous time-weighted rate of return over the 10-year period is the time-weighted average. $5 %% times \frac 310 plus 10 %% times \frac 710 equals \frac 5 %% times 3 plus 10 %% times 710 equal 8.5 %. Example 3. Consider another example to calculate the annualized ordinary rate of return over a 5-year period of an investment that returns 10% p for 2 of the 5 years and minus 3% p for the other 3. The ordinary time-weighted return over the 5-year period is 1 plus 0.10 and plus 0.10 and minus 0.3 and minus 0.3 and minus 0.3 minus 1 equals 1.12 times 0.973 minus 1 equals 0.104334 equals 10.4334%. And after annualization, the rate of return is 1.12 times 0.9731/2 plus 3 minus 1 equals 1.200 minus 1 equals 2.0% p. The length of time over which the rate of return was 10% was 2 years, which appears in the power of 2 on the 1.1 factor, 1.12. Likewise, the rate of return was minus 3% for 3 years, which appears in the power of 3 on the 0.97 factor. The result is then annualized over the overall 5-year period. Portfolio performance measurement. Investment managers are judged on investment activity which is under their control. If they have no control over the timing of flows, then compensating for the timing of flows, applying the true time-weighted return method to a portfolio is a superior measure of the performance of the investment manager at the overall portfolio level. Internal flows and the performance elements within a portfolio. Internal flows are transactions such as purchases and sales of holdings within a portfolio in which the cash used for purchases and the cash proceeds of sales is also contained in the same portfolio, so there is no external flow. A cash dividend on a stock in a portfolio, which is retained in the same portfolio as the stock, is a flow from the stock to the cash account within the portfolio. It is internal to the portfolio, but external to both the stock and the cash account when they are considered individually in isolation from one another. The time-weighted method only captures the effect attributable to the size and timing of internal flows in aggregate, i.e., insofar as they result in the overall performance of the portfolio. This is for the same reason that the time-weighted method neutralizes the effect of flows. It therefore does not capture the performance of parts of a portfolio, such as the performance due to individual security-level decisions, so effectively as it captures the overall portfolio performance. The time-weighted return of a particular security from initial purchase to eventual final sale is the same, regardless of the presence or absence of interim purchases and sales, their timing, size, and the prevailing market conditions. It always matches the share price performance including dividends, etc. Unless this feature of the time-weighted return is the desired objective, it arguably makes the time-weighted method less informative than alternative methodologies for investment performance attribution at the level of individual instruments. For performance attribution at individual security level to be meaningful in many cases depends on the return being different from the share price return. If the individual security return matches the share price return, the transaction timing effect is 0. See example 4 below, which illustrates this feature of the time-weighted method. Example 4. Let us imagine an investor purchases 10 shares at $10 per share. Then the investor adds another 5 shares in the same company bought at the market price of $12 per share, ignoring transaction costs. The entire holding of 15 shares is then sold at $11 per share. The second purchase appears to be badly timed compared with the first. Is this poor timing apparent from the time-weighted holding period return of the shares, in isolation from the cash in the portfolio? To calculate the time-weighted return of these particular shareholdings, in isolation from the cash used to purchase the shares, treat the purchase of shares as an external inflow. Then the first sub-period growth factor preceding the second purchase, when there are just the first 10 shares, is $\frac text in value text value equals \frac 10 times 12 10 times 10 equals \frac 120 100 equal $1.2 and growth factor over the second subperiod following the second purchase when there are 15 shares altogether is $frac text in value text value equals \frac 15 times 11 15 times 12 equals \frac 165 180 equals 0.90 1666 $L. So the overall period growth factor is product of subperiod growth factors equals first subperiod growth factor times second subperiod growth factor. $equals \frac 120 100 times \frac 165 180 $. Equals \frac 120 times 165 100 times 180 $. Equals \frac 19,000 800 $18,000 equals 1.1, and the time-weighted holding period return is growth factor minus 1 equals 0.1 equals 10%, which is the same as the simple return calculated using the change in the share price. $equals \frac text in value text start value text start value equals \frac 11 minus 10 $10. The poor timing of the second purchase has made no difference to the performance of the investment in shares calculated using the time-weighted method compared, for instance, with a pure buy and hold strategy, i.e., buying all the shares at the beginning and holding them until the end of the period. Comparison with other returns methods. Other methods exist to compensate for external flows when calculating investment returns. Such methods are known as money-weighted or dollar-weighted methods. Time-weighted return is higher than the result of other methods of calculating the investment return when external flows are badly timed. Refer to example 4 above. Internal rate of return. One of these methods is the internal rate of return. Like the true time-weighted return method, the internal rate of return is also based on a compounding principle. It is a discount rate that will set the net present value of all external flows and the terminal value equal to the value of the initial investment. However, solving the equation to find an estimate of the internal rate of return generally requires an iterative numerical method and sometimes returns multiple results. The internal rate of return is commonly used for measuring the performance of private equity investments, because the principal partner, the investment manager, has greater control over the timing of cash flows, rather than the limited partner, the end investor. Simple Diets method. The simple diets method applies a simple rate of interest principle as opposed to the compounding principle underlying the internal rate of return method, and further assumes that flows occur at the midpoint within the time interval, or equivalently that they are distributed evenly throughout the time interval. However, the simple diets method is unsuitable when such assumptions are invalid and will produce different results from those of other methods in such a case. The simple diets returns of two or more different constituent assets in a portfolio over the same period can be combined to derive the simple diets portfolio return by taking the weighted average. The weights are the start value plus half the net inflow. Example 5. Applying the simple diets method to the shares purchased in example 4 above. $text simple diets return equals \frac text gain or loss text start value plus \frac 12 times text net inflow gain or loss equals end value minus start value minus net inflow equals 165 minus 100 minus 60 equals 5. So $text simple diets return equals \frac 5 100 plus \frac 12 times 60 $. Equals \frac 5 $130 equals 3.86% 2D p, which is noticeably lower than the 10% time-weighted return. Modified diets method. The modified diets method is another method that, like the simple diets method, applies a simple rate of interest principle. Instead of comparing the gain in value net of flows with the initial value of the portfolio, it compares the net gain in value with average capital over the time interval. Average capital allows for the timing of each external flow. Since the difference between the modified diets method and the internal rate of return method is that the modified diets method is based on a simple rate of interest principle, whereas the internal rate of return method applies a compounding principle, the two methods produce similar results over short time intervals if the rates of return are low. Over longer time periods, with significant flows relative to the size of the portfolio, and where the returns are not low, then the differences are more significant. Like the simple diets method, the modified diets returns of two or more different constituent assets in a portfolio over the same period can be combined to derive the modified diets portfolio return by taking the weighted average. The weight to be applied to the return on each asset in this case is the average capital of the asset. Example 6. Referring again to the scenario described in examples 4 and 5, if the second purchase occurs exactly halfway through the overall period, the modified diets method has the same result as the simple diets method. If the second purchase is earlier than halfway through the overall period, the gain, which is $5, is still the same, but the average capital is greater than the start value plus half the net inflow, making the denominator of the modified diets return greater than that in the simple diets method. In this case, the modified diets return is less than the simple diets return. If the second purchase is later than halfway through the overall period, the gain, which is $5, is still the same, but the average capital is less than the start value plus half the net inflow, making the denominator of the modified diet return less than that in the simple diet method. In this case, the modified diet return is greater than the simple diet return. No matter how late during the period the second purchase of shares occurs, the average capital is greater than 100, and so the modified diet return is less than 5%. This is still noticeably less than the 10% time-weighted return. Linked returns methods. Calculating the true time-weighted return depends on the availability of portfolio valuations during the investment period. If valuations are not available when each flow occurs, the time-weighted return can only be estimated by linking returns for contiguous subperiods together geometrically, using subperiods at the end of which valuations are available. Such an approximate time-weighted return method is prone to overstate or understate the true time-weighted return. Linked internal rate of return lira is another such method that is sometimes used to approximate the true time-weighted return. It combines the true time-weighted rate of return method with the internal rate of return IRR method. The internal rate of return is estimated over regular time intervals, and then the results are linked geometrically. For example, if the internal rate of return over successive years is 4%, 9%, 5%, and 11%, then the lira equals 1.4x, 1.9x, 1.5x, 1.111 equal 32.12%. If the regular time periods are not years, then calculate either the unannualized holding period version of the IRR for each time interval or the IRR for each time interval firstly, then convert each one to a holding period return over the time interval, and you then link together these holding period returns to obtain a lira. Returns methods in the absence of flows. If there are no external flows, then all of these methods time-weighted return, internal rate of return, modified diet method, etc. give identical results. It is only the various ways they handle flows that makes them different from each other. Logarithmic returns. The continuous or logarithmic return method is not a competing method of compensating for flows. It is simply the natural logarithm $ln\left\frac to m1 at $, of the growth factor. Fees. To measure returns net of fees, allow the value of the portfolio to be reduced by the amount of the fees. To calculate returns gross of fees, compensate for them by treating them as an external flow. I exclude the negative effect of accrued fees from valuations. Annual rate of return. Return and rate of return are sometimes treated as interchangeable terms, but the return calculated by a method such as the time-weighted method is the holding period return per dollar or per some other unit of currency, not per year or other unit of time, unless the holding period happens to be 1 year. Annualization, which means conversion to an annual rate of return, is a separate process. Refer to the article rate of return.